Imagine two friends, Lydia and Azim, both considering buying their first home in Miri, Sarawak. They're both excited but quickly realize there are different types of housing loan margins on offer, 90% and 100%. This puzzle marks the start of their homeownership journey. Lydia visits her bank and learns that a 90% loan margin means the bank is willing to finance up to 90% of the house price, while she needs to pay the remaining 10% upfront as a down payment. For a RM400,000 house, Lydia must come up with RM40,000 herself. The bank covers the rest, RM360,000, but Lydia also has to think about legal fees, stamp duty, and other moving costs, all of which require more savings. In contrast, Azim hears about a 100% loan margin, a full loan. If he qualifies, the bank will finance the entire house value. With the same RM400,000 house, Azim doesn't need to make a down payment. However, Azim notices that these full loans are typically limited to first-time homebuyers and may be subject to stricter eligibility and income considerations. The interest rates could also be slightly higher, and sometimes certain fees might not be fully covered by the 100% margin, so he should check the fine print carefully. Both friends research further. Lydia, with a stable job and some savings, prefers the 90% margin because the interest rate is lower and her monthly installments are more manageable due to a smaller loan amount. She feels more comfortable knowing banks often reserve the highest margins for people they deem safer bets. The larger the down payment, the less risk the bank takes. Azim, meanwhile, is just starting his career and doesn't have much set aside for an upfront payment. The 100% margin appeals to him. He can own a house without delay, even though his monthly payments are higher and the bank scrutinizes his application more closely. During a coffee meetup, the two compare notes. Lydia shares the importance of budgeting for extra costs on top of the down payment, while Azim talks about the need for strong credit scores and proof of steady income to qualify for a 100% margin. Lydia's parents advise her that by investing more upfront, she saves on lifelong interest costs. Azim's older brother encourages him to carefully read loan documents because some packages might only cover the property price but not government fees or insurance. Finally, Lydia decides on a 90% margin, using savings for the down payment and feeling secure with a smaller debt. Azim applies for a 100% loan, relieved he can step into homeownership sooner, though he watches his budgeting closely each month. Their stories illustrate the key differences in loan margins in Miri, Sarawak. 90% margin requires some savings, but offers lower rates and monthly costs, while 100% margin fits buyers who lack cash for down payments, but qualify under stricter conditions. Each path leads to a home, but the journey differs depending on individual circumstances.